Hello, network of fellow mining investors, industry leaders, technical professionals, and generalists, or anyone looking to learn more about mining investments. I am Host Rock Capital founder and CEO Mitch Vanderydt, also former junior gold mining corporate executive in Europe, sell side mining analyst in Toronto, and 10-year mining geotechnical engineer, during which time I also picked up a professional engineering license in Ontario and an MBA from a top Canadian school. My 17-year professional career has been broadly focused on helping to dig big holes in the ground and make sturdy piles beside them so that highly coveted metals can be extracted. Lots of things need to happen before you can dig a big hole in the ground and make a big pile, regardless of where you are in the world. And I am quite well versed on what those things are, their intricacies, and how to best sequence and navigate their critical path, given my diverse background covering engineering, construction, environment, permitting, and finance. And while the first 10 years of my career was spent helping to design and build some dozens or so mines, most of which were open pits, I've spent the last 7 years sharing my acquired knowledge to help identify and plan mines, along with helping to attract the much needed funding required for their development, as I continue to do today with the introduction of Host Rock Capital's brand new newsletter launched over last weekend called Metals Mining Company Insights. The newsletter series aims to provide research and analysis of various junior mining companies and increase their visibility among investors. And this first edition covers a Quebec gold explorer called Sirios Resources, whose substantial resource upgrade for flagship Cheechoo project announced last month caught our eye, as it immediately looked cheap on enterprise value per ounce resource, and after a closer look at its technical attributes, namely its pit-constrained grade exceeding 1 gram per ton, and its strip ratio coming in under 3:1, meaning 3 tons of waste for every 1 ton ore, Cheechoo also stood out amid our investment filtering criteria for gold open pits that considers the combined impact of both grade and strip ratio. Because for Cheechoo, the open pit grade and strip ratio appeared only okay on their own, but were much more attractive when considered in combination, as shown on the chart in figure 5 of the newsletter, which is also copied below in the comments, and which I will also pull up on my screen now. As you can see, this filtering criteria chart ranks open pit gold mines and projects along tilted horizontal axes by economic potential based on their grade and strip ratio alone. The chart's axis is tilted gently such that the ranking scheme considers grade more heavily than strip ratio, as grade remains king, and it is loosely calibrated such that the NPVs for similar sized projects increase as you move along the tilted axes. Conversely, NPVs for similar sized projects should remain relatively constant when you move perpendicular to the axes. And so shown on the chart now are 25 open pit gold deposits from across the globe according to their pit constrained grades and strip ratios. They're ranked from lower economic potential in the upper left to higher economic potential in the lower right. And I'll caution the group is non-exhaustive. We include significant open pit gold deposits that we are aware of as benchmarks against which we test other projects of interest such as Cheechoo. I'll also reiterate that this framework considers only grade and strip ratio and does not consider many other important economic factors, such as deposit size, growth potential, underground mining potential at depth, and metallurgical recovery. Lastly, I'll caution that these grades and strip ratios relate to specific studies at points in history and are subject to change over time through drilling, study, and changes to cutoff grades, etc. With that, I want to provide you with a rundown of the top 15 open pit gold deposits according to this ranking scheme of the non-exhaustive group of 25. The top spot, or most attractive open pit according to this framework, is Eskay Creek Gold Silver Project in BC, held by Sirios Resources. With its super high strip ratio of 7.5, that is more than offset by best-in-class open pit grade of 4 grams per ton gold equivalent. Skeena trades at a market cap of 2.4 billion US. The second spot is held by the Dixie open pit deposit within Great Bear project in Ontario, which has the second highest open pit grade of the group, coming in at 3 grams per ton, which is more than high enough to offset its high strip ratio over 6. I had first flagged these Dixie open pit attributes to the market back in late 2020 with my colleague on the sell side, long before they were announced by the company. And the project was acquired by Kinross the following year in the $1 billion US cash acquisition of Great Bear Resources. Behind Dixie in third spot, but in similar ballpark as Dixie grade and strip wise, is the old 2011 Meadowbank deposit in Nunavut, according to its reserve statement at that time, which was around the time the mine came online, which was several years after it was acquired by Agnico Eagle in a $710 million Canadian deal for Cumberland Resources. And this was actually the very first open pit I worked on back in 2008 when it was under construction. And here is a shot of young 22-year-old Mitch pumping grout on the night shift in preparation for open pit mining to begin. Number 4 is Ikkari in Finland, held by Rupert Resources, which jumps down a notch in grade but remains over 2 grams per ton, which is still relatively high for open pits, but with a much lower strip ratio than prior deposits mentioned, which for Ikkari is under 4-to-1. This is another one from my old sell side coverage that had been right behind Great Bear in my pecking order at the time, as it is on this chart. And I had also flagged these open pit attributes to the market back in early 2021 before they were disseminated by the company. Rupert now trades at a market cap of 880 US million and is already partly owned by Agnico Eagle Mines. The fifth spot near the top of the chart is producing mine Séguéla in Côte d'Ivoire, which has a grade of 2.7 grams per ton, significantly higher than that of Ikkari, but actually trails Ikkari on this chart due to Séguéla's super high strip ratio over 8, which means 8 trucks of waste need to be hauled out of the pit for every single truck of the high grade ore. And that is a lot of material to move. Séguéla was acquired by Fortuna Mining in the 2021 1.1 billion Canadian acquisition of Rox Gold. Number 6 is the huge 30 million ounce Donlin deposit in Alaska, a high grade open pit, which is sort of rare in Alaska, where open pits tend to be lower grade. Donlin's grade is over 2 grams per ton, but strip ratio over 5, meaning lots of barren rock to haul. Nova Gold holds majority interest in Donlin and has a market cap of 2.3 billion US. The 7th spot brings us down to the lower grade, lower strip part of the chart, and is held by Filo del Sol gold copper silver project on the Chilean-Argentinian border, which has a more typical open pit grade, just over 1 gram per ton gold. Equivalent, that is, with strong economics made possible by also having a low strip ratio below 2. Filo del Sol was acquired by Lundin Mining BHP joint venture in the 2024 4 billion Canadian Filo acquisition. Number 8 is Valley Gold in Yukon, which is in the same ballpark as Filo with a typical open pit grade just over 1 gram per ton, but with a very low strip ratio that's also just over 1. And this yielded strong economics and super low all-in sustaining costs below $900 an ounce in a PEA announced recently, which led to an $80 million bought deal financing announced last week, led by Canaccord and BMO. 9th spot is Kopsa Gold Copper in Finland, which is much smaller than most others on this chart, but it's growing fast, especially after I personally moved to Europe to list the asset in Sweden for the world's top mining IPO of 2022 as the CEO of the project's prior owner, North Gold AB, before the stock rose 8 times out of the gate and finished the year up 41%. At North Gold, I put half of all funds raised directly in the ground as diamond drilling, which doubled COPS's size and total depth. Since 2022, COPS has grown at a best-in-class rate of 73 ounces gold equivalent per meter drilled to just shy of the 1 million ounce gold equivalent mark where it stands now. The asset was recently transferred to ASX-listed Nordic Resources, which just kicked off a 5,000 meter drill program aimed largely at growing this COPSA deposit. These attributes plotted on this chart come from COPS's old 2023 pit-constrained resource grade of 1.05 grams per ton gold equivalent, combined with its low strip ratio of 1.7 from an unoptimized pit shell, which stacks up well against the larger global deposits on this chart. And the favorable geometry and continuity of COPS's gold, copper, silver mineralization suggests there is lots of room for growth, particularly at depth as the bulk of the deposit is still within 150 meters from surface. And while some success drilling is needed, COPS's geology is quite consistent, and we see this open pit deposit getting much deeper and much bigger. There is probably even some room to push the strip ratio higher as the pit is deepened while maintaining a similar grade. And a pit slope optimizing exercise at the right time would help minimize COPS's strip ratio and maximize its economic potential. Nordic Resources trades cheap at a market cap of roughly 20 million US, and all of this helped make it our top pick among our Gold Explorer Group's 31 ASX listed peers. And full disclosure, we do hold a decent sized position in this stock dating back to North Gold's formation and listing, and from substantial buying in the market, as well as through participation in Nordic Resources' most recent financing at 6 cents, which appeared too cheap to pass on. And here is a photo of my ringing the bell at NASDAQ Stockholm for North Gold's listing with the team. And here in front of the live feed to Wall Street, and here having a look at COPS's core over in Finland. Moving on to number 10, in the lower left corner of the chart is Pebble Gold Copper, another 30 million ounce Alaskan deposit. And that's only the starter deposit. Historic estimates had pegged its ultimate size an order of magnitude higher at 300 million ounce gold equivalent, roughly half from copper. And the jury is still out on what size a project will be permitted here, if any, but this 30 million ounce starter pit has almost no waste with a strip ratio of 0.12 to 1. This means there is nearly 10 times more ore than waste. This super low strip ratio helps Pebble starter pit stack up well against global peers on this chart, despite its relatively low gold equivalent grade of 0.7 grams per ton. Pebble is held by Northern Dynasty with a market cap that recently cratered to just below $500 million US. 11th spot is held by Canadian Malartic's old 2008 PEA project, as the mine has now been in production for many years and is starting to near depletion. Malartic has been a trailblazer as one of the first low-grade open pits of its time, with a grade just under 0.9 grams per ton, with the economic operation made possible by the deposit also having a very low strip ratio, just over 1. The original Osisko Mining Jr. built this mine themselves before selling it to an Agnico Eagle JV in a 2014 $3.9 billion US deal. You will notice that Agnico Eagle strategically picked up a lot of these attractive open pits over the past 2 decades, which has certainly played a role in the company's outperformance among senior gold producers over the past decade. Moving on to number 12, which is the reason we're here, Sirios Resources Cheechoo deposit in Quebec, which was just recently enlarged by 55% to 3 million ounce, which included a pit-constrained 2.5 million ounce grading over 1 gram per ton with a strip ratio just under 3, which, as I mentioned, did not sound spectacular on their own, but when considered in combination on this chart, stand out against global open pit peers in terms of economic potential implied. And this alerted us to buy the stock, write this newsletter, and publish this chart. Cheechoo is still growing fast at 35 ounces per meter drilled, and at a market cap of only 20 million, we have made this stock our top pick among our Gold Explorer Group's 61 North American listed stocks. Next, for number 13, is the Koné project in Côte d'Ivoire, held by Montage Gold with a market cap of 254 million US. Koné is plotted along the same economic line as Cheechoo, but at a lower grade and lower strip end of the spectrum, with a grade just over 0.7 grams per ton, offset by a very low strip ratio just over 1. Number 14, also on the same economic potential line as Cheechoo, is the 2021 reserve for the currently producing Detour Lake mine. I have some history with this project too, as I spent a fair amount of time on site during its development and construction between 2009 and 2011, when it was largely a penny stock, before watching the former owner Detour Gold Corp appreciate nearly 100 times in value before the stock was acquired for $5 billion in the 2022 acquisition by Kirkland Lake, which was then merged into Agnico Eagle. Detour taught me firsthand the immense value creation that is possible only in the mining business. And very quickly, here are a few photos of myself on site doing geotechnical drilling back in 2009, where I recall spending my 23rd birthday. The whiskey jacks eat right out of your hand in Northern Ontario, which kept me busy while in the bush standing by the rig. Last but not least in this top 15 rundown is the Melina project on the Hemi property in Australia, which was acquired by Northern Star Resources in late 2024, announced acquisition of De Grey Mining for 3.25 billion US. This deposit brings us back towards the higher grade, higher strip end of the spectrum, with a grade over 1.5 and a strip just over 6. And that sums up our rundown of notable open pit gold projects according to our filtering criteria. As mentioned, all the projects on this chart have their merit and their attributes can improve over time, which is often the case as more drilling is completed. And that was exactly the case at Detour, which used to plot differently on this chart back when I worked there circa 2010. When it had a higher grade, this grade is around 0.8, it used to grade just over 1, but with a much higher strip ratio up around 6. So I used to plot around here. But by drilling out the deposit's lower grade zones and waste zones, and by Kirkland Lake employing a low grade stockpiling strategy helped by higher metal prices, this mine's economics have been greatly improved over the years. By lowering its average grade slightly, while also lowering its strip ratio by a larger margin, which basically moved the project up 5 spots on this chart from a ranking of 19th to a ranking of 14th. And in many ways, this type of migration is the name of the game for open pit mine optimization. And I'd expect the case to be similar for some of these newer projects at the lower end of the spectrum, such as El Zorro, Liva, Tunquila, Gold Rock, and even Marbin. These projects are all still relatively new and not yet extensively drilled. Over time, I would expect all 5 of these projects to move up on this conceptual economic scale by lowering their grades slightly while also lowering their strip ratio more substantially, such that they will migrate down on this chart and slightly to the left, thereby moving up in economic potential, much like Detour did over the years. Perhaps there are other open pit gold deposits out there that also stack up well on this chart, and we'd be happy to discuss adding them and featuring them on future publications or content. So please do reach out to us at info@hostrockcapital.com if you have any questions, comments, or inquiries, and we can usually find time to chat with investors about mining stocks and metals markets. And we would be happy to explore new ways we can help issuers make and advance their plans to grow deposits, dig big holes, and make big piles, including helping describe the right messaging that attracts the right investors. Otherwise, a big thanks to our some 3,000 combined followers across LinkedIn and X, and now also YouTube. Whatever the platform, please follow us for more content if you don't already, and hit that like or repost button if you appreciated the content. Until next time, mind your metals, everyone. Forget about tech stocks and crypto. They're in a bubble. It's about to burst. This is not investment advice for informational and educational purposes only. All investments carry risk. Do your research, consult professionals before making any trade or investment. Thanks for tuning in.